corporate governance is one of the key issues in this whole financial crisis. Certainly the superannuation industry is taking a strong lead in this country. It needs to spread to overseas countries. The big institutional investors must be putting pressure on the big financial institutions and the companies internationally to make sure that this present crisis is not repeated.
Through ACSI and others, we've been responsible for some significant advances in corporate governance in Australia. But we have to understand you can't legislate for honesty, and there'll always be people who try to beat the system.
For a long time as an industry, we've known that there's been governance problems. We've talked about governance problems, and now they've come back to bite us.
I think the changes that have happened right across the Western world have been so dramatic, where large organisations with decades, if not centuries, of experience now no longer exist. I think that's shaken up the system, and I really believe that going forward, the governance issues will be so prominent in running of organisations that we'll have a much more improved system, and especially a much more reliable system as far as superannuation investment is concerned.
I think Australia tends to have a pretty good balance between government intervention and allowing the industry to serve its own needs, and I think that needs to continue. Certainly there are some improvements that can be made, but there can also be an over-inquiry-like attitude, if you like, and at some stage we just have to get on with it. I'm not exactly sure what the balance is, but I think we have to be careful not to go too far in either direction.
I think all the evidence is that if you are ticking all the boxes for good governance and social responsibility, that your returns will actually be better.
In terms of corporate governance for funds, I think that funds need to be looking at the way they made decisions just to make sure that those models are the best that they possibly can be for the future.
The modern day fund really needs to invest a lot of time in training and skilling their directors beyond just having a board for a legal requirement, but really equipping them with the skills that they need to really probe investment decisions and make the right decisions for the members.
We need to continually improve our investment governance processes, and this is globally, and it's something that we should continue to focus on our risk management and making sure that in all levels we understand the sort of investments that we invest in.
There's always going to be those in corporate Australia who are going to look to see how can they take as much as they possibly can out, whilst saying what good social citizens they are. The good thing about Australia is that from time to time they get caught, and very occasionally we actually manage to put them behind bars.
We have an excellent panel to really explore this topic of governance and is it something that we've seen before and what should we be doing. Byrne, who's the CEO of the Australian Council of Superannuation Investors, will be speaking first of all, giving the global perspectives on governance. Martin Lawrence is then going to speak. Martin's from Riskmetrics, and he's going to be talking about the DNA of directors and the depth of that director pool. And then Erik, who is the founder and managing director of Regnan, is going to talk about some of the longer-term, bigger picture governance issues that we need to be thinking about.
I was going to start today with a quote on the great financial crisis. I really can't bring myself to call it the GFC. And it's from the International Corporate Governance Network that actually put out a statement on the financial crisis late last year. They said corporate governance failures were not the only cause, but they were significant. Above all, because boards failed to understand and manage risk and tolerated perverse incentives. Enhanced corporate governance practices should therefore be central to an overall solution aimed at restoring confidence to markets and protecting us from future crises. So, is this just Groundhog Day, or does it just take us to make a whole lot of mistakes as we go along? I want to remind you of what I think now are some previous groundhog moments. I think if we think back to the high-tech bubble and then bust, we might remember that we learnt about conflict of interest between analysts and brokers. If we then think of Enron and WorldCom, we learnt about auditors and audit committees and their independence. We learnt about some of the deficiencies in accounting, and we learned about accounting standards. In our own HIH, we also learned about accounting issues, the failure of corporate culture, the effect of a dominant CEO, and also some regulator failures, and probably many more. Justice Stewart reminded us too about box ticking, and he makes a nice quote about box ticking, and then he says there's little point in having a corporate governance model if the directors fail to examine periodically its practical effectiveness. So we must stop that box ticking and move to real action. Now in the great financial crisis, we've also learned about risk management. Again, the mismatch of remuneration, incentives. We've learned about board quality. I was always very interested to find that the Lehman board had no one who'd worked in the financial sector on it, but did have a number of people who managed art galleries. We learnt about the misuse of off-balance sheet entities, and we also learnt about the failure of too little regulation, and probably many more. So what do we need to do to make sure that this doesn't happen again? Can I just take us back then to 2001 here? If we recall, there was a flurry of activity in Australia. The Corporations Act was rewritten, the ASX listing rules made fundamental changes and introduced the 10 key principles of good governance. They talk about composition, size and adequate boards. They talk about disclosure, timely and balanced. They talk about remuneration, being remunerated fairly, and I can't read my other word, I apologise. Plus, there was the introduction of the non-binding vote on remuneration policy. So in Australia, essentially we tried to strike that balance between black-letter law and principles-based approach to corporate governance. Some people in this financial crisis have suggested that shareholders in fact failed to hold boards to account. This is very hard to do when markets are rising so rapidly, when everyone is focused on that short-term return. But in some markets, shareholders do not have the opportunity to hold boards to account. Let me now give you some examples of our governance framework that does give us some key points to hold boards to account. It's not perfect. It does require, though, companies to apply both the spirit and the letter of disclosure provisions, better transparency, and look at shareholder value. We can vote for and against resolutions, and they have a binding effect on the board. We can propose a resolution to appoint or remove a director. We have an advisory vote on remuneration, and there is, in most cases, the separation of the role of the chair and the CEO. So let's look at what happens elsewhere. And I did a survey of some of the ICGN submissions just over the last year. There was a letter written to authorities in the US saying that people should be able to vote for directors. Currently we can vote for them or abstain. We can't vote against them. Brokers vote your shares if you do not. There's no say on remuneration, and there's a whole range of poison pill arrangements which essentially can entrench a board and make sure shareholders don't get their value. In European countries, there's also issues. There's been submissions about the role of the supervisory boards and the management boards. The management boards need to give more to the supervisory board in terms of shareholder relations. There was also a very interesting discussion I found in a submission to a Dutch inquiry, which actually suggested that chairmen should not have a small amount of time for shareholders to speak, but should allow the conversation to keep going rather than saying each speech is 3 minutes. Another concern was one that would allow management a 180-day period to respond to resolutions proposed by shareholders. This was on top of already a requirement for 60 days in advance of a general meeting. So in fact it gave management 8 months to respond. These are simple issues that have been raised, it seems to me. In Sweden there was a submission about equal treatment of shareholders, 1 share, 1 vote. I then had a look at some of our neighbours. In Indonesia there was a whole range of submissions to make sure that the minority rights for shareholders. In Singapore, 49 out of 50 companies rely on show of hands for a poll. We do that here, but we also count the votes that are in the envelopes. In Singapore, you have to attend the meeting. So I thought maybe CMSF could have a meeting there and we could all vote our shares sometime next year. We know in Japan the boards are dominated by non-independent directors, and all the meetings are within an extraordinarily short time frame, so it's very difficult for shareholders to vote. So weak shareholder rights, in my view, limit the ability of us as fiduciaries to hold boards to account. So this must be improved both here and around the world. I think we have a responsibility to sort out our own backyard, but also I think we should transmit good ideas from Australia across the globe. So finally, as institutional shareholders, we must recognise our responsibility to generate long-term value on behalf of our members. We need to make sure we hire the fund managers that put sufficient resources into governance analysis that does deliver long-term value by taking governance factors into account, and we need to consider the riskiness of a company's business model as part of their investment decision-making. So it's my contention that we will only not have another Groundhog Day if, in fact, there is an increase in shareholder rights around the world.
Thank you very much, Anne. I'd just like to add an observation about Taiwan, which a colleague of mine based in Singapore was telling me. In Taiwan, he was trying to do some research on behalf of a client of ours on the biographies of the directors of the company. There weren't any. Then he was trying to find the names of the directors of the company, and he couldn't find them either. In Taiwan, actually, as a shareholder who's voting through a custodian, which would be almost everyone in this room and almost all institutional shareholders, you don't actually get to know the names of the directors on who you're meant to be voting before the AGM. They tell the market 2 days beforehand. So things could be better in Australia, but there can be a lot worse. I sometimes wonder whether, as shareholders, as governance advisors, we expect too much from company boards. After all, they are a group of people who can be sitting at the top of a company with $100 billion in assets that's generating $5–10 billion of profits with who knows how many employees around the world. Is it reasonable to expect these individuals to be on top of the organisation, to not know everything that's happening, but at least to be sure of the risk management systems, to be sure that the accounting systems are working adequately, to be sure of the management teams? I guess the response is that as shareholders in the public company model we have got, basically around the world with some variations from place to place, you don't have much else to go on. Your fundamental right as a shareholder in a listed company in Australia, in the UK, even in the United States, is to appoint and remove directors. It's the parliamentary model of democracy. Just as a citizen in a country like Australia, you don't get to vote on every single piece of government policy. You get to elect a representative, and if you don't like what the representative or their party does, you get rid of them and appoint someone else. Fundamentally, the power to govern the company is vested in the board. To give you an example from executive pay, which is something that everyone hears a lot about, particularly in downturns, shareholder power over executive pay is still relatively limited because it is vested in the hands of the boards. Shareholders have some control over share-based pay. Shareholders have some control in certain circumstances over payments to directors and termination payments, and will have a little bit more control should proposed legislation come to pass. But ultimately, cash in the hand, they've got almost no control over. So electing directors, choosing directors, is very important. It's the fundamental right that shareholders enjoy. And I think since the last set of governance crises in 2000, 2001, there was a lot of attention paid to board composition, the balance between independent and non-executive directors, the balance between executive directors and non-executive directors. And I think shareholders and organisations such as ourselves have done a reasonable job in bringing boards up to speed, and boards themselves have responded quite well. The next step, though, is the tricky one, and that's who are these people who are trusted to look after your members' retirement savings, and if you own shares directly, your personal savings. So I decided, for the purposes of this, to have a quick snapshot of the largest group of companies in Australia. So we looked at the director backgrounds, the non-executive director backgrounds of the top 20, as of December 31, 2000 and as of December 31, 2008. We picked the top 20 because we didn't have a lot of time to do this, and it covers about 65% of the market, so it's broadly representative. Ended up with about 160 directorships in both times, and I should say a copy of the paper, the short paper, is available outside. There are limited copies. If you're after a copy and can't get one, please get in touch with me or with the conference organisers. And we were looking to see what had changed in the background of the directors on those boards and in the basic composition of those boards in that 8-year period when shareholders had paid a lot more attention to corporate governance than they had in the past through organisations such as ACSI, through renewed focus by fund managers. And we also tried to look at where do non-executive directors come from? That's a hard question to answer. The first thing I'll say, and this actually comes from research that we have done on behalf of ACSI over several years, more than half of all the new appointments to top 100 company boards since 2005 have been individuals who are already on top 100 company boards or have previously been on a top 100 company board. So seemingly there is a lot of appointing from within. Now, whether or not this is a good thing or not depends on your view of why this is happening, but it's an interesting statistic. The other thing to bear in mind when you're looking at boards is to remember that despite the fact that it's shareholders who elect and remove them, history in Australia is that boards are pretty much overwhelmingly self-selected. There are occasions when fund managers, when investors have thumped the table and said, we want board change. The NAB board in 2004 is a case that people often point to. But by and large, the way you get onto a company board is to get the endorsement of the people who are already on it. In 2008, in the top 100, 94% of all votes cast on resolutions to do with directors were cast in favour of management. In 2005, it was 96.4. And actually, that stat for 2008 would probably be about 96.4 if you excluded Kerry Stokes' attempts to remove the Western Australian News Board at the beginning of 2008. Boards still between 2000 and 2008 are overwhelmingly male. Now, they're slightly less male than they were, but they're still pretty much male. This panel would be a very unrepresentative company board if it was a company board. In 2000, 11.3% of all directorships were held by women, and in 2008 it was 16.4%. In 2000, there were no executive directors in the top 20 who were women. In 2008, there are 2 out of 34. Most non-executive directors are former executives of large companies. In 2008, just under 50% of all non-executive directors on boards were former executives from 3 basic areas. One of them was your general executive who'd been an executive across a range of industrials companies. The next sector was the resources and materials sector. And the third sector was banking, insurance, finance. That figure was 43% in 2000. One of the interesting things within this, and I guess it is interesting to think of as we confront the reality of the global financial crisis and companies carrying too much debt, is that the big change in there was in the number of executives who had a background in banking, finance and insurance. In 2000, 12.7% of top 20 company non-executive directors had backgrounds in banking, finance, insurance, and in 2008 that had grown to 20%. Then you've got investment bankers who make up Former investment bankers make up about 8% of the sample in both periods. One of the striking things, and I find this interesting because the allegation that always gets levelled at me by company chairmen, usually when we're disagreeing with them, is that we've never run a company, we've never built a company, we have no idea what we're doing as a result. People who had actually built a company, as in invested and risked their own capital as opposed to managed other people's, accounted for less than 5% of the sample in 2008 and less than 5% of the sample in 2000. Boards are overwhelmingly made up of former executives of large organisations managing money on behalf of other people. Nor is the public service very well represented. It's under 4% in both 2000 and 2008. And actually, if you excluded Rio Tinto from the sample, where the old joke is that it's the retirement village for former diplomats in the British Foreign Service, that figure would be a lot lower. The other big change, I guess, between 2000 and 2008 is an increasing professionalisation of non-executive directors, and this may come back to the appointments from within that I mentioned before. In 2000, 28% of non-executive directors had day jobs. That is, they did something else. They're either an executive of another company, which is fairly common in America but not so common here, or typically they were an advisor to listed companies. They were a lawyer, they were a consultant, or they were an investment banker. In 2008, 83% of non-executive directors didn't have a full-time job. That is, they were, by and large, professional non-executive directors. And it's the decline in service providers to boards that overwhelmingly accounts for that increasing lack of day jobs, which may mean that all the attention lavished on independence and such matters has had something to do with board selection. There's an old quote from a man called Rod Halstead, who was a partner of a law firm, and he was quoted in 2004 in the Financial Review saying, well, of course as a lawyer, as a partner, you'd always go on a board. That's how you get the legal work. I'd imagine that Rod Halstead's firm wishes he hadn't said that, because I've certainly reused the quote on a number of occasions. But that idea seems to have changed, particularly amongst big companies, and that's by and large a good thing. And the final piece, and I'll end with some good news about board composition, is that in 2000, 11 boards had one or none of their members as non-executive directors who had expertise in the industry in which their company operated. That is, there were 11 companies out of 20, of the largest 20, where the board was dependent either on one individual among their own number or the executive team for expertise about that industry. In 2008, that number had fallen to 3, and I think we'd all agree that that's a good thing. By and large, where does this leave us? Leave it with 2 questions, I guess, and for many of the people in the room here who are members of trustee boards, think of your own situation when you think about this point. The first one is, does this lack of diversity in listed company boards, is it a help? Would you be happy to be on a trustee board that exhibited these characteristics? And the second one is, does the self-selection model for company boards, for the individuals who serve on company boards, does that make sense in terms of the investors they are meant to represent? And that's not necessarily the fault of boards. After all, it's not the boards who have meant that they get far more than 90% of the vote usually when they stand. With that, I'll hand over. Thank you.
So, Erik.
Thanks, Amanda. My task on this panel is to try and add by defining risk and governance in a broader way. And I think actually my role's been made redundant by David Liddy. Those who are in here this morning would have heard him say that all of our fund managers, your fund managers, they don't ask him about values. They've never asked him about sustainability, and they've never asked him about succession planning. So it's very interesting that the issues that perhaps are relevant to long-term wealth creation are in fact just not on the agenda at all. Look, I want to make a couple of points, and I've just got a couple of slides in relation to backing up the talk with a bit of walk in terms of some performance data. Just cast our minds back to the UNPRI in April 2006 when the New York Stock Exchange launched those principles. If you talk to James Gifford, who's the Australian who runs that secretariat, and many of you are members of the UNPRI. It was launched with much aplomb. In fact, James was down on the floor and a New York stockbroker was looking up at all the dignitaries and US and other pension funds who are on the little balcony ringing the bell and said to James, hey, what's the PRA stock and who's the little African guy? Of course, the little African guy was a little African called Kofi Annan. But anyway, then when ACSI came out and suggested not many months later that Australian funds should support those principles, you did that in spades. And today we find that 50% of Australian funds under management are managed with recognition to the principles of the UNPRI, which you all know are to value, be a responsible owner, to encourage disclosure, to collaborate, to promote the principles and to report. It's not very, very difficult. The other thing that we want to make the point about is the ESG-RA, ESG Research Australia. It's an initiative that has been driven out of, well, first, my understanding is pension funds overseas in the UK and the Enhanced Analytics Initiative, and now developing a method whereby those brokers, those analysts who do ask David Liddy about his succession planning, his values and his sustainability, and do then report and inform their clients as a service provider, will be rewarded better for that. Again, it seems like a blinding flash of the bleeding obvious that this should be occurring, and the fact that we've got to dangle a huge bag of money in front of people to make it happen is something that we should all probably think about later on. But it is sending a signal, and it's important. And then what I want to do is just close on the fact that this is investable, and I've got 4 little slides to put up. The first is that the ESG factors in relation to, and that's environmental, social and corporate governance, they really are recasting the way we look at risk and opportunity. And the only positive thing I think that's come out of the global financial crisis is the fact that these things are now as obvious as they are, and the call to action is as clear as it is. So the 3 things I want to take you through are some research that we've been doing with Goldman Sachs JB Weir, and many of you will be familiar with Andrew Gray. You know, we have a wonderful market for ESG in Australia. We have 2 analysts, Elaine Pryor and Andrew Gray, and they service the whole market because nobody else does anything. Thanks to the benevolence of your fund managers, occasionally they'll give those 2 individuals some tagged brokerage so that they don't continue to dance on the envelope of redundancy in the organisation that they work in. And I'm sorry if that's a bit caustic, but that's a reality, that they are not rewarded appropriately for the work that they do. Workplace health and safety, ethics and culture, and corporate governance. Three areas. Workplace health and safety. A number of you as trustees, this is again a case of blinding flash of the bleeding obvious. It's about operational risk, and we're suggesting that this is something that you and your fund managers should be looking at as a signal of risk throughout the cycle. The second is ethics and culture. In a moment I'll put up the first research that I'm aware of that tries to measure the ethics and culture of organisations and whether or not there's a financial benefit out of that. And the last is corporate governance, which is really all about alignment, and both Anne and Martin have spoken about that. If we just flick over to the next slide on workplace health and safety, what you can see there up in the top left-hand corner is back in about September of 2004, October 2004, is a basket of stocks and an index created at that time. And if you had sold those companies who don't exhibit strong workplace health and safety governance, as measured by Monash University, then you would have made good money out of using that as a sell signal for those stocks up until the last time we updated this data in October 2007, and we'll be running it again shortly. And interestingly, that bottom line, the one that slopes most down to the right, in this case you want that to slope down to the right, because you would have made around about 30% simply by not investing in companies who had poor board performance and oversight of health and safety issues. On all measures you would have made money. Interestingly, the top one, you wouldn't have made much money by investing in companies who link remuneration outcomes to health and safety. I can't comment on the merit of that. It's counterintuitive to what we expected, but it's there, and it seems to be a fairly consistent signal. If we move to the next one, I'm very excited about this because this is the first time this information's ever been put anywhere, and I had to break Andrew Gray's arm in order to get that, because he's going to release a report shortly to highlight this. But it's again a blinding flash of the bleeding obvious. If you had invested in ethics as a concept over the last 5 years or so, you would have made money. And again, the benchmark, the 100 index on the left-hand side of the slides, is if you had bought the companies who exhibited strong ethical governance, and if you had sold some of those who didn't, and you're buying 30 companies, you're selling 70 on this particular piece of research. Effectively, whether you were looking at the ethics and culture policy, or the risk identification by the company, or its oversight and linking it to remuneration, you would have made money particularly through volatile times. And we're still learning as we go. As I say, this is the first time this has been done. And in fact, you wouldn't have made money up until about September of last year, as you can see as those lines come through the 100 index. But by crikey, the last 6-9 months, that issue of ethics has really come to the fore and is a very, very strong signal. Moving to the last slide, this is the one for which we have the greatest amount of data, which is corporate governance. It's benchmarking a number of factors back to August 2001, so it's a much stronger time series. But again, the message is very clear that in almost all instances, except for audit, if you had taken these things into account, so I beg your pardon, in terms of accounting governance, that's the bottom line with the little triangles, the Goldie one, you would have made money. And in particular, I draw your attention to the fact that the overall line, which is very close to the overall in the middle of the right-hand side of the chart, if you had blended these various characteristics, you would have made money, and in fact you would have made more than 10% return above the market. So if you had not done anything else and had just simply invested this as a theme, on all of these issues you would make money. So I think the call to action is looking at governance is something that is obvious from a fiduciary perspective. It's about risk management. The other thing is that there is a very strong case that it is financially responsible. And I just wanted to put through those E, S and G factors as issues that we all need to be starting to think about much more robustly and embedding in terms of our investment practices.
Thanks, Erik. So there's certainly some pretty compelling charts there, and you made the interesting point at the start that there's a high representation of PRI signatories in terms of funds under management, but also from an absolute number, there's more PRI signatories as Australian asset owners than any other country in the world. And Anne, you touched on Australia showing leadership in governance more specifically. Our take-up of the PRI and, I guess, acceptance of this investment proposition has been leading, and is there much opportunity for us to influence the sort of global dialogue around these issues in terms of the PRI and influence the global asset owners?
There has been a very large take-up of Australian funds with the UN PRI, and I think, can I just talk about why I think that's happened in Australia before I talk then about how we can influence others? It seems to me that when you look back, I think we do learn from our mistakes and have learnt from those mistakes. And we also understand regulation, so we have been able to put in place a regulatory framework that does more or less work. The thing that I find quite striking when I observe Australia and then look particularly at the US, we have opportunities here to have conversations with directors. We just had one, a session before. When I talk to colleagues in the US, they don't have those opportunities. Boards resist talking to shareholders. It's maybe partly because we're a smaller community, but we do have opportunities. And also I think because we have that separation largely of the role of the CEO and the chairman, that, the CEO is always selling the company, giving them the market data, but if you've got a person who's a different person being the chair, they then have a role with shareholders. So we can talk about all of those things and talk about them with the data that Erik has put forward, that in fact you can have a different system that works. One of the difficult things, though, is to actually talk to other jurisdictions that are in fact much larger than us. So when you're talking with US asset owners, their assets are much bigger than ours, but we have to sort of put forward the lessons that we've learnt. And you can do that through a range of things. I think a number of funds are members of international organisations. ACSI has conversations with the Council of Institutional Investors and other funds. I think the only way to do it is, in fact, by talking. But the other thing, I think now, as all funds start to get larger, is start to think about the processes of voting international shares. That funds now have largely, and the number of Australian funds who vote their shares has increased dramatically. It's now that we're big and bold enough, I suppose, we start then to look at the international sphere. We all have international equity portfolios, and how do we start to influence by actually voting our shares? And you can then join together, or we've got to be very careful about that, in all sorts of jurisdictions, but actually support some of the initiatives that are coming out of other countries. Almost, I think Martin will know the exact number, but there are many shareholder resolutions in the US about getting some sort of non-binding vote on remuneration. They go up at every time. There's also lots of resolutions about, the compositions of boards and those sorts of things. So I think now is the time for us to really show our influence by voting.
So a lot of opportunity there.
If I could just add one thing. Actually, the American governance community has found itself very surprised. About 3 weeks ago, they discovered they were actually getting a say-on-pay vote, a remuneration report vote in the United States. It's not the entire market, but any company that has received federal bailout funds will now have a say-on-pay vote. And everyone expected that to happen in 2010, but it's actually going to happen for any company that files its proxy, its notice of meeting, after February the 16th, I think, which caught everyone by surprise, the business community, the investment community. Certainly my colleagues in the United States were slightly panicked by it. So we have say-on-pay for a limited section in the United States, about 400 companies now.
So, Martin, I had a skim of your paper, and anybody who was as fascinated by the stats and wants to steal them for their presentation should get a copy of Martin's paper. But I sort of came away from it thinking, gosh, is a good director really just a panacea?
If only it were that easy. I guess the original thought from everyone was if we can solve board independence issues, then that'll do something. The unfortunate truth is that just about every academic study ever done in this area shows that there is no correlation between board independence and company performance. I actually think that they're perhaps looking at the wrong things, and most of these studies of the United States where, to be honest, the definitions around independence are pretty weird. You can actually own 13% of the company and be defined as independent in the United States. It's not a panacea. You will always have cases where stuff happens. Either the company's in an industry doesn't have a sustainable business model, the board can't stand up to a CEO. But I think, I've flippantly said this a number of times, I've always thought that if a board is in a position at the moment where it has to have an uncomfortable position with its executive team or an uncomfortable discussion with its shareholders, it will usually opt for the uncomfortable discussion with its shareholders. And wouldn't it be good if that was reversed?
So, Erik, a lot of these themes that are coming up, your work and some of the bigger picture issues that Anne and Martin have been talking about, to be really considered and to break governance Groundhog Day, are going to have to be considered across the investment supply chain, right from the trustee board through to the brokers who are actually doing the research. And as you said, there's only 2 of them in the Australian market. So with that in mind, what is the weakest link in that supply chain at the moment in terms of getting your charts built into normal investment processes, and how do we strengthen that link?
Yeah, look, I don't know that there's just one link. I think from our perspective, we think that we need a top-down, bottom-up approach. The dialogue that's occurring between funds directly and boards is something that needs to continue. I think today was a major breakthrough in and of itself, having the directors here and the conversation that was happened. One CEO of a fund has already suggested to me that they might be getting a couple of directors in just to present to their board or meet with them on an occasional basis, and that would be a fantastic thing if that occurred as part of building the network of understanding. With the brokers and the fund managers, though, the problem is that they are just remunerated completely the wrong way. And an order of magnitude measure of that is a couple of years ago we were trying to recruit a former banking analyst into our team. And apart from the fact that the salaries were not quite within our reach, there was the fact that this individual coming out of a broking community who actually had weekly KPIs. This individual, and as part of your system, our system of superannuation, that individual was measured based on the weekly turnover that individual generated from their research. And by all means have good active research and what have you, but we think that is just too active, and I think David Liddy said it all this morning. He's not asked about sustainability. Well, why is he going to do too much about it if he's not going to get rewarded? He's not asked about succession planning. He's not asked about values. These are things that need to be embedded, and those managers, I do think it's a case of encouraging the research, and the ESG RA initiative is a wonderful initiative to do this in a positive way. It's all about carrot. And I think the carrots are wonderful things. I also am a big believer in sticks. And the reality is, if you wanted to fix the problem, Amanda, the harsh reality is put the bodies of 6 leading company directors who just don't get this stuff on the floor so that everyone can see, oh gosh, that's what happens if you don't do this, right? And you don't look after shareholders' interests. And there are those who can be identified in such a way. Then they're out there, and that's a good signal for everyone else. And I think the other thing is the hiring and firing of managers who embed these things properly. I'm aware of one fund who tell me that they had a short list of 3 Aussie share managers, and the board did overlook one fund manager because they were regarded as not taking governance seriously. And I said to Fred or Mary, the person who told me this story, I said, Fred, Mary, that's great that your board knows that, but if you don't let the market know that, then all that fund manager thinks is, well, we didn't get the mandate for whatever reason. They can manufacture whatever the reason might be. The other thing is that all the other managers also don't get the signal either.
Time for a quick pop quiz. Who's seen the governance Groundhog Day? Oh, no, sorry. Who's seen Groundhog Day and can remember what Bill Murray had to do to break the Groundhog Day? Yep, quick call out. Like, is it Kiss the Girl? Yeah. Anything else? It must have been, I remembered the Kiss the Girl moment as well. I don't know if it really means I'm a romantic, but Anne remembered the you've got to be nice to people thing. So I don't know what that says about us, but Anne, what's your what to break Governance Groundhog Day? What needs to be the kiss the girl or be nice to people moment?
Well, I think there's a couple of things really. I was really quite flabbergasted this morning when, Bank of Queensland tells us no one has ever asked them any questions. And I don't know whether other people in the room were, because I have assumed and have been told by various fund managers that they all do ask those questions. So we now need to go back and just confirm whether or not that is the case, or they were just at a different meeting. So we do have to ask those particular questions. I don't know, but, were other people surprised? Yeah, I think to me it was, wow. ACSI, though, has had that quite a number of times from various chairmen of boards, that they have not been asked about these particular issues. So in that way, I suppose I shouldn't have been surprised. I suppose people really have to take notice of what's happened. We do have to learn from our mistakes, Amanda. We do have to make sure we are voting our shares where we don't have sufficient rights. We have to support jurisdictions to make sure that we do have the rights to actually vote our shares. And if we, in fact, think that a board is not doing its job, we have to do what the board members suggested, and that is, in fact, start to vote them off. And really start to think about that. Because most of the directors you meet, I think, they are wanting to do a very good job for their company. They are looking for the longer term, and I think in some ways we might need to support them to make sure our side, or the people asking the questions, the fund managers who are asking the questions, are really also looking at the long term as well.
I think we've got to make sure that the chairman are actually talking to the fund managers, I think.
That's right.
It's another thing as well. Martin, what's your kiss the girl moment?
Wow, man.
Follows on what Anne said, use the franchise. Votes that aren't exercised are useless. And I think institutional investors in Australia have shown what you can achieve with judicious use of your rights as a shareholder over the past 5 or 6 years. Seen a sort of fund manager revolt against cheap takeovers a couple of years ago. We've seen really major shifts in the way that executives are paid and in the sort of structures that go into it, and board sensitivity to shareholder concerns on these issues. And that's come from using the shareholder franchise, through making boards realise that the owners of the company are not silent, they do exist. And so the next step is use the franchise to protect your fundamental right, which is get people in there who you're comfortable with managing your capital.
Erik?
I think my suggestion is builds on and works with Anne and Martin's suggestion. I think that the superannuation funds of Australia have an enormous opportunity to actually promote some of the director talent pool. At the moment, as Martin said, it's all self-selected, and the words in and bred come to mind in some instances. You are a franchise who touch so many areas, particularly with that wonderful gem that we've got at employee and employer representation. You come across so many people. When you meet people that are interesting, who have business skills, think about them and go, gee, would this person be good on some of my company boards? And then we need to have a structure to be able to promote those people, not about tickets, not about, you've got to put these 4 people on or else, but about saying when you're looking for talent, these are the sorts of people that we think represent some of the thinking that we think is appropriate. And so then, Mitsubishi, please consider.
So another question to the whole panel. One of the things that's been suggested is that the great financial crisis, or the global financial crisis, is going to be the jolt that the investment community needs to really take governance seriously. So a question to the whole panel. Do you think that is the case? And if so, what should we definitely not be talking about this time next year?
Let's hope we're not talking about the share market still going on. So that's the one I'd like to be talking about. Let me think about the one thing that I don't want to be talking about this time next year, that in fact there has been no change to the regulatory system in the USA. That is the thing that I do not want to be talking about. I want there to be substantial change with people being able to vote against directors. I think it's in the US, vote for, you abstain, but you can never actually vote one off. I think it's pretty weird, which means me as the CEO can put boards up. They can get a vote of, I presume 60% against, but they're all still happily going along there, or everyone could abstain. So that's what I think I don't want to be talking about. Whether or not I think this is the jolt, no, I think we're all human beings, and I think it's another, as I put before, a series of lessons that we've learned. So we learnt all those lessons in 2001 and then on, and this now will be more lessons that we'll learn, but unfortunately I think there might be some others that haven't been recognised that come up. It seems to be that we don't do something about these things until something actually happens, even though ACSI's guidelines and the other guidelines that were talked about this morning have a whole range of things in them. Unless there's actually a lesson about one of them, people don't seem to take them seriously, and I'm not sure why. Martin might have the answer.
Martin?
I think it's not what we're talking about next year, it's what we're talking about in 6 to 8 years when the next great bull market happens, if it ever happens, which I'm sure it will. I'm not hopeful, and you only have to look back. This probably comes from having a father-in-law who's an accounting professor and obsessed with company collapses. But if you have a look at the key features of the companies that have collapsed in Australia in the boom times, after the boom times in the 50s, after the boom times in the 60s, after the boom times in the 70s, after the boom times in the 80s, after the boom times in the late 90s, and just recently, they all share a lot of characteristics. Complexity, dominant individuals, weak boards. Seemingly when the money gets flowing, everyone forgets. I think we're getting slightly better at it each time, but I don't think... I'm not hopeful.
Erik, any optimism for us?
Look, I think there's a lot of cause for optimism. I think that one of the things that Keith DeLacy said this morning about how much there is so much more that unites us than actually divides us. Building on that conversation, I do think that as an industry, though, what would be good is to build upon initiatives so that our culture is that when we identify the problems, we fix them, and we fix them as quickly as we possibly can. So I think, for example, executive remuneration, let's all work towards getting a particular strategy in place that people are comfortable with, provides more of a platform and addresses the issue, and then move on, and then hold boards accountable for the performance of that. That's one example. I won't start talking about climate change and everything else. I know the organisers have put my name in green on the little introduction slide there, and I won't take the bait on that one at this time.
And
I was going to say, I think it's not that I'm not optimistic. I do think people have learned, and I do think that there will be great improvements. And I know people, just when you look at the increase in the number of shares being voted over the last, I think, 4 years, it's incredible. And I think that is very optimistic that shareholders are having a say about what they want to have happen. And I'd hate to me to be speaking at a thing called building confidence, you to go away to think that I'm incredibly pessimistic about governance. I think, in fact, it is optimistic, but there are learnings along the way, and I don't actually think it's easy. I don't think it's an easy thing for people to understand. Phil Spathis and I have tried to work out a sort of a research project on ethical minds, and we haven't got that far. So it is a really difficult thing to instill and understand what it is, and how do you measure a board for its ethics, and what does that mean to be ethical, what does it mean to be independent. And I think we need to continue to think about those sorts of things.
I just wanted to add something. Last week when the government announced its various changes to executive pay, including the shift to the severance package arrangement, so that now any payment in excess of 12 months on termination will need to be approved by shareholders, which is a position I know that ACSI and others have been advocating for years, including Don Argus, I think, many years ago in conversations with ACSI. And a journalist asked me, but he's the big end of town. Are the big institutional investors actually going to use this vote to veto termination packages? I said, well, yes. The only 2 times that termination packages have been actually so badly worded, or they haven't had decent legal advice that they've had to put it to their shareholders in the top 100, which are Tattersalls and Oxiana. In both times, in Tattersalls' case, that resolution was almost defeated, but the chairman cast the undirected proxies, where someone just ticks the box and says, give my vote to the chairman, which is usually something retail investors do. He cast them in favour and it passed that way. And at Oxiana, we know that a majority of shareholders voted against the termination payment, but the majority of shares voted were against the termination payment, a majority of shareholders were in favour. So the pressure that is coming from institutional investors. So it's easy to, I guess, beat up on institutional investors, fund managers, super funds for not doing enough, but that's when most of the heavy lifting is coming from, such as it is.
So there's lots of calls to action and reasons for optimism, and so I'll now throw to the floor for questions. And we've got one up the back. David Atkin, CEO of CEBA.
Picking up Martin's comment about the recent government announcements, do you think there's any truth to the rumour that the ability to retain senior executives within the Australian market is going to be impacted by the changes to termination payments?
Well, it's the end of the world if you'll read some of the commentary by some learned company directors and some organisations that represent directors and executives. I won't say represent business. I guess the response to that is, if you have a look back at the various fears that have been talked about in the past, when the government, for example, said in 1998, you're going to have to disclose the details of the remuneration received by senior executives, and at the time, the executive lobby said, well, this is going to lead to kidnapping. No executive or their family would be safe in their beds. 6 years later, when the executive lobby was in Canberra arguing against the non-binding remuneration report, a couple of senators asked, has anyone been kidnapped since disclosure was introduced? No one has. The US has the largest and most generous termination payment arrangements of the developed markets. The average kind of go-away money in the US is 3 times remuneration. If the best termination arrangements get you the best executives, then we should expect the best executives to be running the biggest companies in the United States with the biggest termination payments, and I don't think that's true if you look at recent evidence.
Ted Murphy, UniSuper. My question is for Anne. And on the basis, Anne, of your contention that we can probably prevent it being Groundhog Day again by building shareholder rights or increasing shareholder rights, I'd like to raise the question whether we're too focused on corporate governance, in the sense that it's been clear for the last 3 or 4 years, if not longer, that there was a debt-fuelled asset bubble globally. But enough economists had pointed that out, enough academics had pointed it out, even the odd business sector spokesperson had acknowledged that. Are we too focused on corporate governance compared to also being focused on regulatory issues in respect of government obligations to regulate the economy? Have we missed the boat in the sense of to what extent ACSI, its international counterparts work as capital, we're not also basically saying to governments, to international authorities, there is a debt-fueled asset bubble and there needs to be a change in national and global regulation to stop it. So we got the balance between corporate governance and political action right. My suspicion is we haven't. That's why I wanted to put that on the table.
Yeah, I think that's a very good question, Ted, and something. Yeah, so are we too focused on the minutiae of corporate governance and in fact not actually looking, in fact, what is the biggest picture? I know that from work that ACSI did before I was there, that there was a whole lot of discussion with companies, in fact, about transparency, about what they were telling their shareholders and directors. And so it wasn't really about governance, it was about that bigger question of investors understanding what, in fact, people are involved in. So I do think you can get too focused on that nitty-gritty, and we probably do need to look broader and to actually, as a governance group, for all of us to really understand in great detail what it is we are investing in and what it is that is causing markets to rise or then markets to fall. So I don't think to say we're too focused. I think we just have to make sure we can just always talk about governance. We must also talk about what is investment value and what is the value of an investment. And if we do think that something is going off the rails, we need to pinpoint it. Because I found it quite interesting that people said it was, in some instances, that shareholders were at fault. And I thought, well, no, they weren't, because this in fact was something else other than governance failures. There were governance failures that went along. So maybe we also, though, have to be louder on those other issues as well. And maybe we're learning through governance how to actually be more astute about the questions that we ask.
Howard Rosario from Westscheme. I wonder, you possibly haven't even thought about it, but is it implicit in your view and in how you regard fiduciary duty that a superannuation fund trustee should be an active investor, not an enhanced investor? And I've got another issue as well. A number of us use proxy voting policies and proxy voting service agencies. What's wrong with them that they're not getting this right either?
Can I answer the second question first? Speaking as a proxy voting advisor. That's all right. I ponder this question myself. I'll take the easy route first and say what we do well. We do well on classifying boards in terms of independence and non-independence. We're very good at looking at executive pay structures, and we're getting much better, I think, at looking at what's going on in the reality of executive pay in terms of payment. The thing where we don't do the best job we could is around director competence. And that's because that's incredibly hard to do. We've just finished some work, which we're going to sort of release publicly soon, trying to track individual director returns, so returns to individual directors, the total shareholder return they add across a portfolio of boards. And the results are bizarre, to be honest with you. And directors who you look at and think, well, I thought they were a really good director, they've got a great reputation, you look at the boards they're on and go, well, actually everything he's been on has underperformed, this is awful. And the problem becomes, is the individual being dragged down by those around him? Is it just circumstance? And this is, I guess, the fundamental riddle. Boards tend to function collectively. There's not a lot of dissent from what we know. When there is board dissent, it tends to boil out into the front page of the papers, but they're elected individually. And it's very, very hard once you knock off the low-hanging fruit of people who've been associated with disastrous misjudgments that were disastrous at the time. It's very hard to, I guess, drill through and say, well, who is a good director and who isn't? That's where we're not doing our job the best that we could do. We're trying to do it better. It's a work in progress. I'll share with you a conversation I had with a fund manager the other day, and we were just talking about the issue of director competence because they'd come to a similar conclusion. And they said, well, whose job is it to look at director competence? And I said, well, we're trying. And he said, but is it really yours? And I said, well, if not us, who? So it's part of our job. We're trying, but it's a hard thing to do.
And
it's a journey. We'll let you know how we're doing very shortly in terms of the director TSR stuff, and then we can maybe work out a way forward together. But long memories help. we've got an informal, I won't call it a blacklist, but a list of directors who we would look at twice. It's growing. And one of the interesting things was in corporate Australia, if you'd been associated with a disaster in the past, you didn't tend to come back. And we're seeing now there's a number of them who are. And so we're doing our best, and some of them have even been promoted. And we're doing our best, I guess, to try and address that easy, low-hanging fruit, if you like, first, simply because in some cases they are on very large boards, which a lot of shareholders' money, a lot of superannuation fund money is invested in.
So, Erik, did you want to touch on that active versus enhanced investor?
Yeah, look, I think the question you ask is a good one, Howard, and the answer I'd give you is from Justice Neville Owen in the HIH Royal Commission in Chapter 6.3, and what he said there was that if shareholders as owners do not convey their concerns and expectations to managements and directors, then those managements and directors will lack guidance from those whose interests they are supposed to serve. And so whether you hold an index fund manager, an enhanced index manager, or an active manager, or as almost all of you do, a blend of all three, I do think that Justice Neville Owen had it right on the money.
So a perfect quote for which to end this session and not cut into your lunchtime. So I hope that's added to your thinking on these issues. Just by way of heads up, the Australian Institute of Super Trustees has actually produced a course for trustees on these issues and how to mainstream ESG issues into your investment processes. So if you want some information on that course, you can go to the AIST booth. But enjoy your lunch and have some further discussions with the panel. Thank you.